Good day everyone, hope you are doing well. In today's video we are going to go over how to draw a Fibonacci and how we can use an inverse fair value gap as a confluence for your entries on the specific zones on the Fibonacci. Alright, so please make sure you stay tuned so I can show you this awesome indicator on an inverse value gap, how it's going to help you. Also, please leave a like and subscribe. Let me know in the comments below if you found this video valuable. Alright, so the first thing we are going to look at Fibonacci and inverse fair value gap. We're going to look at what Fibonacci retracement is, why it works, how to draw it from the right swing high to low, which levels matters most, and how you can use it in confluence with structure, order blocks, etc. In this video, we are going to use the inverse fair value gap. Now, before we go to the charts, I'm going to go through this document just so that you can be 100% sure you understand before we go to the charts, and then everything is going to make sense. Now, what is a Fibonacci retracement and why it works? Literally, a Fibonacci is just a tool we use to figure out where price might pull back before continuing into the same direction. You've probably seen it before, those horizontal lines that people draw between highs and lows. Now, that is the Fib retracement. Now, as you can see here, this is our Fibonacci levels. Everything is going to make sense when I show you on the charts. Now, why does Fibonacci work? It's based on a super old mathematical pattern called the Fibonacci sequence. Now, in trading, it helps us to spot areas where price might bounce or reverse because a lot of traders and big institutions watch these levels. Basically, what we are going to look for, if this is going to be price, we are going to look for an impulse down or up. In this example, an impulse down. Now we're going to draw our fib from the high to the low from where that impulse started, and then we are going to wait for these levels. Everything will make sense when we go to the charts, but we are going to wait for price to retrace to one of these levels, and we are going to enter on a confluence with the inverse fair value gap on these levels. This is just a line chart. As you can see, this is how it will look on a real chart. Your high and your low and price retraced to the 76.8 level here and then came down. Now, an inverse fair value gap. So to put it nice and simple, so a fair value gap is basically where price imbalances, where the market moves so quickly that it skipped over some of the levels. But an inverse fair value gap is basically just the opposite. An inverse fair value gap is basically a normal fair value gap that has not been respected. It broke through and retests on the opposite side, and that becomes an inverse fair value gap. So here you can see it's an old fair value gap like a zone, but instead of continuing the move, it reverses direction with force. Here's a nice thing. It's almost like price says, hey, remember this gap we left behind? You're not sticking around here. Boom, rejection. But anyway, how is an inverse fair value gap different from the regular inverse fair value gap? Now, here is the purposes of it. Now, the purpose of a fair value gap used to predict continuations. Inverse fair value gap used to predict reversals. Action, price fills the gap and keeps going. Inverse fair value gap, price fills the gap but then reverse. The mindset, imbalance, support, resistance. Inverse fair value gap is imbalance, trap, and rejection. With a regular fair value gap, you are expecting price to come into the gap, maybe chill for a bit, and then continue in the same direction. But with an inverse fair value gap, price comes back to the revisited gap and then rejects it and reverses. Now your cue, so that's your cue to look for a counter trend and reversals. Now why does this matter? Because an inverse fair value gap gives you warning signs of a shift, they are especially powerful when they form after a liquidity sweep, line up with Fibonacci levels, and show clear rejection with a wick or break of structure. Let's jump to the charts and then I can show you exactly how this works. Alright, so what we are going to look for, we're going to look for a price move down or up. It depends on which way the market is going. So let's say, for example, we have an uptrend and we are waiting for price to make a nice impulse move. So let's say price makes the nice impulse move. We are going to wait for price to retrace to one of the fib levels. So let's say, for example, you draw your fib from this high to this low right over here. We are going to wait for price to retrace to one of these levels. Now there's a few levels we can retrace to, like as mentioned before. Your 0.3 is a nice level where price can retrace and reverse if the trend is nice and strong. So price won't always pull back into our preferred zone right over here. So you'll notice sometimes price will just come to the 0.3 when the trend is nice and strong, and then price will continue down. So let's say, for example, price come up, price come into our 0.76 and our 61 zone, for example. What we are going to wait for is when price made this impulse move, we are going to look for an inverse fair value gap that was created right over here where price needs to come into and then reverse. So we're going to wait for price and then reverse. So that's the setup we are looking for. We're looking for a nice big impulse move. We're going to draw our fib from the one swing high in this example to the swing low, and we are going to wait for price to retrace. It's going to work exactly the same in the opposite. So let's say we have a trend coming down and price makes a big impulse move. We are going to draw our fib from this low to this high, and we are going to wait for price to start retracing to one of these levels. Now, you're not only going to enter blindly on one of these levels. We are going to look for a few confirmations. Definitely our first one that we look for, there needs to be an inverse fair value gap on one of these levels where price retrace from and react from. So type of reactions we want like bullish candles, we want some strong signature moves of all right, price is going to respect this level. If you are going to enter aggressive, you can literally enter at the in this case the bottom of the inverse fair value gap, and you can put your stops literally either, if you want to be a little bit more conservative, you can put your stops above the last swing high in this example, or you can put your stops a few pips above the inverse fair value gap, and you can target the next low, and that would be the 0. Same with this side, you can enter aggressively, or you can put your stops below the last swing low. For example, let me just say, if price only comes, for example, to the 30, you are not going to put your stop there. That's way too big. So if there's an inverse fair value gap that was created here, what will you do? You will put your stops below the inverse fair value gap. But if price retraces like to one of our more preferred levels, you can put your stop below the swing low just or high, just to be extra safe for that confirmation. So let's look at a few chart examples, and then I can take you through it. Let's go through a few examples. All right, so you might be wondering, what are these blue lines? This is an indicator that's going to help you identify inverse fair value gaps. Now, as you can see, this was a fair value gap. It was created Remember, a fair value gap is an inverse fair value gap is an fair value gap that is not respected and it breaks through to the opposite side. And normally, when you're trading in the same direction of the trend, the price comes back to the inverse fair value gap tapped, and normally the price will retrace from that entry level right over here. It's an indicator by Flux Charts. All right, so you're going to go to indicators and you're going to type in Flux Charts inverse fair value gap. Flux Charts inverse fair value gap, and you're going to choose the one right here at the top, the volumized inverse fair value gap by Flux Charts, and you're going to add it to your chart. Okay, so when you add this indicator to your chart, there's a few settings that you can change here. Zone invalidation, you can choose close. Inverse fair value gap zone invalidation, you can choose close again. Zone filtering, I keep on average. This you can play around with, but this only gets affected when you change the volume threshold, so you can just keep it nice and standard. The fair value gap detection, you can use the same type. So what the same type means is the candles the same type of the inverse fair value gap or not. So I just put it on all, and you can play around with how often do you want this inverse fair value gaps to show. If you put it on extreme, the more inverse fair value gaps will show. If you put it on low, the less will show. So you can pause the video here and you can put in these settings when you open the inverse fair value gap indicator by Flux Charts. Alright, so let's have a look at a few chart examples. So here you can see, let's just play price a little bit forward. We are waiting for a nice impulse move. You will see inverse fair value gaps will start being created like there. You see there's an inverse fair value gap. So price broke through, retested this level, and now we want price to come down. But hold on, we need extra confirmation. So if you watched all my previous videos, you know the pattern that I trade. We wait for a liquidity sweep. We are going to wait for a market structure shift. Why is this going to be my one that I want for a market structure shift? Because this is the low that broke this high right over here. So I'm not going to enter straightly on this fair value gap. If you want to, you are going to be a little bit aggressive, because remember, price can always break this high again. So we're waiting for extra confirmation. So let's see what happens. I'm going to ignore all of this because I'm waiting for this inverse fair value gap where this was created. So now we had a nice push. We created a low with a nice retracement. So what I'm going to do now, I'm going to draw my fib from this high here to this low right over here. Let's draw our fib. As you can see, we're currently at the 0.3. Let's play forward. Are we going to tap? There we go. We got tapped, as you can see here. Nice bullish, nice bearish engulfing here. So there's an extra confirmation. So if you were a little bit aggressive, you could have put your order right over there. Your stops below this high here. And you can target the 0, and that would be a 3.16 risk to reward trade. If you entered the trade right over there, your risk will go a little bit down, but then it's up to your own discretion. Are you going to keep, now you can lower your risk, or you can keep your risk the same, but then you need to move your stop loss a few pips above the inverse fair value gap, and let's see how this plays out. And there we reach our target. Now you will see on the way the price will react to a lot more fair value gaps right over here. You will see on this leg as well. This was the one I would preferably always look for, an inverse fair value gap at the extremity of this move. So that would be from the 0.61 and up, and that was right over here. So these ones I will ignore. All right, let's jump to the next example. We had a nice liquidity sweep, and we had a big impulse move as well. So let's draw our fib from this low to this high. We are currently at the 0.3. Let's see where price retrace from. For the sake of this video, we want price to retrace to our preferred zones on the Fibonacci. So let's have a look. We are currently on the 15-minute. We had a small reaction from the 61. There was no inverse fair value gap here. We are currently in a fair value gap, but we are waiting for some confirmation, either a smaller inverse fair value gap or some type of confirmation on this level here. Here we come again to the 61 level. Let's just extend this. So here we can see an inverse fair value gap was created right over here on our 61 with a nice impulse. Let's see if the indicator shows it. There we go. Indicator plotted this one out. So this is a nice push, as you can see here. So we on the higher time frame, we when you zoom out the perspective and you take this whole move, we reacted from the 61. We have our equal lows right over here and our liquidity sweeps happening here. So this is all equal lows. We had a liquidity sweep. We had a market structure shift. And now we're literally waiting for price to enter this inverse fair value gap area. And you can put your stops below this low right over here. Why? Because if you're going to put it here, that's way too big, and there was no inverse fair value gap that was created here. So this is safe to say that price is starting to react from the 61 level, and we are going to target the 0. This is going to be the high, so it's going to be a 3.72 risk to reward trade. Let's see if it plays out. And there you go. You have your profit target right over there. So let's quickly recap what happened here. When we look at the bigger picture, we reacted from this order block right over here. We had a liquidity sweep right over here, market structure shift right over here. You can use this one as the fractal high as well. Let me just draw this out. So a liquidity sweep happened here. We came from this order block right over here, as you can see. We had our market structure shift. So this can also be your own discretion. I'm going to make a full video on just market structure shifts, basically just market structure in general. We had a market structure shift here, nice impulse move, price reacted, and this was the next day. Asia session, London session started right over here. We had that big push, entered from our inverse fair value gap here, and we target our next swing high. Let's go through one more example. All right, so let's look at this chart example. You'll see the indicator drew out a few inverse fair value gaps here, broke through, retested, respected. Another one here broke through. We're currently on this one here. Let's see if it gets respected. There's a few left right over here. But now let's quickly, before we continue price, let's see from this move to this move. Are we currently in a level that we want? No, we are not. Here is our, let me just mark it out so you know the zones that I'm looking for. This is going to be our preferred level where we want price to go. So this is basically from your 91 right over here. 76.8 and 61. So this is where we want price to initially go to. So price is starting to retrace. Let's just confirm this. We had a liquidity sweep right over here. Where's our last fractal high? It was here. So we had a market structure shift right over here. Let's see if price taps this level. There we go. So now I'm happy. So now I'm going to, now I want, let me just delete this fib. So now I have the confirmation right over here, price tapped here. So we want a retracement to come down and continue up further to break this high right over here. So let's have a look. There we go. Price immediately retraced. Let's quickly just draw our fib from this low to this high. As you can see, it was the 61 level. Here is the extreme inverse fair value gap here. Let me just mark it out. This one here. Let's see if price comes back to tap this level. There we go. And now we can enter. This low is close enough. If you are a little bit more conservative, you will have more losing trades, but your risk will be low. You can put it beneath here, but also bear in mind there's an order block resting right here in the 91. So to be safe, lower your risk on the trade. It's close enough to the low, and then put your stop below this low, and we target the 0, and that would be a 1.6 risk to reward trade. So let's see how this plays out. As you can see, we literally just missed the 0. It basically there, it's like a few pips, literally. So that was on your own discretion with spreads and stuff. But yes, that's how this is how powerful this indicator is of Flux Charts. So just a quick recap. If you want the indicator, you go to indicators, you type in Flux Charts inverse fair value gap, and you're going to choose this one right over here, and you're going to add it to your chart. Also, please go have a look at Flux Charts. The link is going to be in the description. There's some really awesome indicators that I'm going to go through on different videos, like the price action tool and the pat screener and everything like that. This one is free of charge. You can just add it to your chart. Go have a look and let me know in the comments how you find the inverse fair value gap indicator and how it helps you with your trading. All right, then I'll see you in the next video. Cheers.